a technical breakout is forming beneath the surface, and every spec leader confirms it with a clean move higher. The question isn't whether tech can break out. It's why capital is rotating into speculative positions at all when rates are still elevated. Our metrics show this is a genuine recovery signal, not just relief trade noise. Speculative appetite has returned to full capacity overnight. The data is screaming that risk tolerance shifted from defensive hedging back toward directional positioning. ARKK gained 3.72%, while SPHB surged 4.19%, both outperforming the broader engine by 2 standard deviations. This isn't momentum, this is capital allocation resetting. When spec leaders move before broad participation, institutions are deploying fresh dry powder rather than rotating positions defensively. Credit conditions show a pulse check that reads clean, but barely. Yields fell 1.26% to 4.63%, which suggests the market priced in either a Federal Reserve pivot or stronger than expected earnings momentum across growth sectors. Our metrics confirm this is an easing cycle with upside. When rates drop while the VIX simultaneously compresses from 20+, that's institutional positioning for duration extension, not just tactical trading. Fear has flatlined at healthy levels. The VIX sits at 1647 and UVXY only gained marginally at 1.67%. This tells us the market absorbed yesterday's volatility without panic selling, which means liquidity is deep enough to handle a second leg of earnings-driven moves. The indicators are signaling that downside protection has shifted from defensive sectors into quality growth. A classic sign of institutional confidence rather than retail FOMO. Consumer fundamentals are showing surprising resilience despite tariff headlines and macro uncertainty. Tech's SMH engine surged 4.77% on strong demand signals, while Apple just crossed $10 billion in India sales for the first time. A geographic expansion that validates global demand beyond the US. The data shows earnings beats across semiconductor and cloud infrastructure, which is what actually moves prices when sentiment fractures. Safety assets are participating rather than hoarding. Gold rose 1.11%, while yields compressed, creating an asymmetric setup where duration plays work alongside growth. Bond gained 0.59%, and TLT moved in sync with high-yield credit. This tells us the portfolio is hedging for volatility without abandoning upside potential. A sophisticated rotation that institutions deploy when they expect continued earnings-driven strength despite macro noise. The hero today is capital allocation discipline, fighting back against the villain of overthinking macro headlines. Every sector confirms this isn't a relief rally. Speculative leaders moved first. Tech fundamentals are intact with SpaceX beating estimates and Apple expanding globally. And credit conditions show institutional positioning for duration extension. The portfolio wins by staying positioned through the noise while letting earnings drive price discovery. Because when spec leaders move in lockstep with broad indices like this, that's what recovery looks like under pressure. The verdict is clear. Technical breakout formation combined with genuine earnings momentum means this rally has legs beyond yesterday's relief trade. Expect continued strength into the weekend as more tech earnings flow through the system and institutions validate their positioning. The Canary sings green. Maintain exposure, but watch for any VIX spike above 20 that would signal a rotation back to defensive sectors before the next leg higher.